Keith, can you hear me?
Yes, I can.
Sorry that you couldn't make it out to Run for the Unicorns. We've had an awesome show, and now we get to segue into Keith Teare, the original investor or founding investor into TechCrunch. Take it away, Keith.
Very important.
It's all you, Keith. Take over. Thank you, sir.
Hey, guys. Well, firstly, thanks to Andrew and Jay and the team. I've been an advisor to their company for a long time now, actually. And I think the vision and the team that they put together is pretty awesome. What they've asked me to do today is go up a level to the 60,000 foot level and try to understand a little bit about what's going on in the world of crypto and what is crypto. And I specifically mean crypto, not blockchain. What is crypto and why should we care about it? Just by way of background, you can probably tell I'm British born from my accent, although it's changed a lot over the years. I spent the 1980s doing databases and networks before there was Ethernet, multi-user databases using Twisted Pair. I spent the 90s building Europe's first internet service provider, EasyNet, before there really were internet service providers in '94. And then came to the States and did Real Names, which was, if you've ever seen I'm Feeling Lucky on Google, where you just type in a keyword and you go right to a web page, that was Real Names. We were Google's first partner, actually, and built into the browser. And I just came from a Chinese conference. Real Names created the first Chinese language keyword system where Chinese people could write their own language and go to a web page. That was a web service in 1997, and web services really only took off in about 2005. So we were pretty much ahead of that curve. I've been mobile investing since 2008, and for the last 12 months, been very involved in blockchain, mainly as an advisor to various ICOs, which I've been doing because I'm a big believer that you can only learn something by jumping in and doing it. You can't really read about things or talk to people and expect to understand anything. So what I want to do today is go big picture. I'm going to share my screen. Just bear with me a second. And do a very short presentation. Let me go full screen on this. And I call it the age of the ICO and the end of venture capital, which is kind of important because these days I'm a venture capitalist. I'm one of the founders of a $200 million UK-based venture fund called Accelerated Digital Ventures, and spend about half my time in London making investments in all kinds of companies. So the end of venture capital is basically predicting my own business's death. So let's just talk about why that might be important. I'm going to start with this Jack Dorsey statement, which is from the 25th of March, so just over a month ago, when he said that Bitcoin will eventually be a single global currency. And Dorsey is not a fool. He is the CEO of Square, which transacts a lot of business in dollars and other currencies, as well as being the CEO of Twitter. And so you got to take him seriously when he makes this statement, because his own core business at Square is impacted by it. It's interesting to point out that Dorsey is only the latest in a long line of people who have talked about a single global currency. This is Timothy Geithner talking as US Treasury Secretary, an International Monetary Fund event in 2009, saying he was quite open to the idea of an eventual move towards a global currency. And he makes the writer here, Eric Fontenelle, makes the point that that's an idea that goes all the way back to John Maynard Keynes. Now, why is that significant? John Maynard Keynes was the British economist who lived at the time that the pound sterling ceased to be the world's reserve currency. The British Empire built during 200 years had led to the point where the pound sterling played the role the dollar has been playing for many of the last decades as the primary global reserve currency. And by the time that Keynes was writing in the 30s and 40s and 50s, the decline of the British Empire had led to the belief that the pound was not going to be sustainable as a single currency. And so talk turned to what would replace it. And a single global currency was one of the options. That isn't, of course, how it panned out. The way it panned out is we had World War II, and we went to the gold standard. And eventually the US dollar, as the US economy grew, became the primary global reserve currency. And single world currencies tend to be a mirror of dominant economic systems. Well, guess what? In 2018, we don't have a single dominant economic system. The United States is not playing that role anymore due to its aging. China, the young upstart, can't yet play that role because its currency, the RMB, just wouldn't be a credible alternative. And so once again, the world's beginning to talk about what replaces the reserve currency of the world. Again, this is not a new concept that came along with the blockchain. This is an article that talks about foreign exchange reserves and shows that the dollar today makes up about 64% of foreign exchange reserves. A foreign exchange reserve is basically a global bank that enables nations to trade with each other, even when their own currencies go up and down, like, for example, the Greek currency did recently, the euro, rather, in Greece. This is looking at the last 15 years of global currency reserves, and it shows that the basket is made up of the dollar, the euro, the pound sterling is tiny, under 5%. China, by the way, is growing in that basket. It wasn't in it at all before. Now it's a small piece. But the US is dominant, yet in decline, relative decline, by the way. It's not that the US is shrinking, it's still growing. It's just the rest of the world is growing faster. 2010, UNCTAD, which is a United Nations Conference on Trade and Development, actually called for abandoning the US dollar as a single major reserve currency. And it stated that the new reserve system shouldn't be based on a single currency or even multiple national currencies, but instead something that it called global or international liquidity and a stable global financial system. So interestingly enough, the IMF actually has a currency that plays that role. It's called XDR, which even though it sounds like one, is not a cryptocurrency. XDR is something you could think of as foreign exchange reserves and special drawing rights. It's when the IMF, acting on behalf of a basket of nations, bails out a nation whose currency has failed and whose economy is failing and allows them to get back on their feet. And they use these XDRs. So why am I telling you all this? I'm telling you all this because we live in an age of globalization when single nation states and their currencies, even when the nation state is as strong as the US or as emergently strong as China, increasingly they are too small to impact the globe and to create a coherent world trading system. This is a graph of the extent to which the world economy is made up of trade. That is to say, people spending money on things that were not produced in their own country. And it's now over 60%. The UK mirrors that graph pretty well. About 60%, 50 to 60% on any given year of the UK's GDP is accounted for by trade. The US, it isn't as big. The reason why the US has a big domestic economy, about 5 times to 6 times bigger than the UK's, and so there's a larger amount of domestic consumption and spending, but still on an upward curve around 30% of all US spending is trade-based. China was very high, over 60%. And as the Chinese middle class has begun to grow since 2002, that means that the spending power of Chinese citizens in China has grown. China has actually become less global and more national, but still over 40% of every penny spent in China is spent on things produced outside of China. Now let's look at the share of the world economy accounted for by different nations. This is the share of the US of world GDP measured in producer prices parity. That's a measure of living standards, really. It's declined between 1960 and 2015 massively by more than half. And this is China's share, which has increased by 400% in the same time period. So the world is becoming more global, and the balance in the world is shifting to Asia. In fact, by 2050, 66% of the world's middle class is going to be in Asia. Already in 2014, China overtook the US in terms of its share of GDP measured by what's called purchasing power parity, a measure of living standards. And if you add India into the mix, India and China dwarf the US now by those measures. So you can see that what happened to Britain between the wars is happening again with India, China, and the US as the primary players. And the world relies on a reserve currency, which is the dollar today, largely the dollar. That is not sustainable. And so as we go back to Jack Dorsey and we remember what he said, there's a context here. And that context is that the world needs a stable method of what you could think of as a universal equivalent between currencies. And there are really only two choices: gold, which is what happened last time, and is a really poor solution, or some kind of digital equivalent for gold, which is the role that Bitcoin plays as a store of value. And it seems to me, at least, that the 1/3 of 1% of notes and coins in circulation that Bitcoin represents today, up about 10 times over 12 months, that 1/3 of 1% is a low point in what Bitcoin is going to represent going forward. Think of Bitcoin as a store of value. Ignore whether or not it's a means of exchange, because I think that's a peripheral issue. As a store of value, it is the choice of more and more dollars, and it's the choice of more and more pounds, and it's the choice of more and more RMB. And that, in a way, opens the Pandora's box to the question, what is a store of value? Does it have to be a currency produced by a nation state? And as the world becomes more global, and think of this from a tech point of view, in the 90s, we had the internet, the first global network where people all over the world were nodes on a common network that was end-to-end linked together. The second wave you could think of as smartphones, when two companies, Google and Apple, with two app stores, the Play Store and the Apple Store, together represent 100% of mobile software and devices that reach 3 billion people today. And that's the second wave of globalization. And Bitcoin is the third wave of globalization, where transactions and store of value no longer relies on the legacy banking systems, the central banks and the retail banks that historically formed the basis for storing and accounting for value. So that's a pretty major moment in history that we're sitting in. So if money is a store of value and it's a unit of account, and it can be, but doesn't have to be, a medium of exchange, then we're at the beginning of new methods of doing all three things. And in a way, that's what an ICO is, or a token sale. A token sale is when an underlying set of value, and let's focus on people who make games, but it could be any human effort. All human effort creates value, and that value gets stored in symbolic notes and coins of some kind. When a company says, I'm going to produce a token, and I'm going to store the value of the ecosystem I represent in that token, what it's doing is trusting a new store of value more than it trusts the dollar, the pound, or any other fiat currency. That seems to be a smart thing to do in a growing global world where the balance between nation states and therefore the stability of fiat currencies is in question. So to me, an ICO is simply a method of adding a new token to the collective store of value that crypto represents, that pushes it from 0.2% to 0.3% when Ethereum was added, and from 0.3% to 0.4% when LTC is added, and so on and so forth for every single credible token that represents real underlying value. You could think of Filecoin as one of these. You can think of, the bottom layer, Ethereum and Bitcoin are what I would think of as foundational stores of value. And then you've got vertical stores of value, industry by industry or business by business. And collectively, they represent a shift by the human race and initially by the early adopters to new stores of value. I'm going to just spend a few minutes talking about how this might impact venture capital, because I started with, is venture capital screwed? Well, the reason you would ask that question is venture capital invests in equity. And it seems unlikely going forward that entrepreneurs will choose to sell equity. It seems more likely that entrepreneurs will choose to sell shares in an ecosystem via the tokens that store the value of that ecosystem. And that's probably true of venture as much as anything else. And if it is, every venture fund we know today is at risk. And Andrew and Jay have some big ideas for venture. Let me share my ideas for venture, which I think are incredibly aligned with what they said. So you all saw the disclaimer, right? So let's just talk about venture. Venture is made up of really two value creators. The first are the startups and the founders who do something, create something, invent something. And the second is the investors who are prepared to take the risk of putting money into those efforts. That's 100% of the value of the ecosystem. People either work on one side or the other of this binary equation. Venture is historically incredibly illiquid because the investor invests for years, often many, many years. In fact, exits are increasingly averaging at more than 10 years before an investor sees money back. And founders are even more illiquid because they tend to only have one equity, the one that they're building in their own startup, and they're tied into it until there's an exit for the most part. So it's a very, very illiquid ecosystem. And that creates incredibly slow turnaround of money. Money gets locked up for 10 years, whereas in retail, for example, the average dollar bill will change hands many times every day. So the velocity of money is really slow. What if you could fix that whilst putting a lot more money into startups? This is just a kind of an indication of how illiquid venture is. I've done a lot of startups. 2 of them were unicorns. Many of them failed. The ones that fail die at the top of this reverse pyramid. They just don't survive the early phases. But even the ones that do survive, which is about 3%, end up taking a very, very long time. So that's the illiquidity. We can measure that illiquidity. This is from Crunchbase. $600 billion was invested over the last 10 years at various different stages. That's produced about 1.8 trillion of exits, by the way. But those exits came from about 5% of the investments. 95% of those investments are still illiquid. So greater than half a trillion of those investments are still illiquid. And if you look forward to the next 10 years, taking 2017 as an anchor, it's going to be something like 1.3 trillion of illiquid assets in startups that are just trapped. So what if you tokenized this? What if instead of using equity and cash, you use tokens? Well, that's what Venture Network is going to be doing, which is a project I'm associated with, along with the project that Andrew and Jay are doing. We're going to do a couple of things. We're going to create a token issuing authority in Switzerland. That authority is going to do an ICO, and it's going to invest the proceeds in a fund in Bermuda. The fund will be managed by me and my team. And the assets we invest in, 80% of them are going to be put into a marketplace where they can be taken. Now, how will you be able to take them? Well, we are going to start a gifting of tokens, a little bit like United Airline miles. We're going to, for every company that is funded in box 2 here, we are going to rely on Crunchbase to validate the funding. And let's use the example of $1 million funding. We're going to give 1 venture token per dollar to the lead investor and 1 venture token per dollar to the founder. They can distribute them to their teams. Those will be gifts. Those gifts can be exchanged for the assets in the marketplace, thus allowing the founders to trade some portion of their liquidity into a liquid asset in the marketplace. And that's from 80% of the assets that the fund invests in. So both the founder and the investor will have liquidity. The ICO for this, by the way, is going to price these tokens at a cent, and the reward system gives 1 token for every dollar invested. So it's roughly 1% cash back on every funding event on the planet, starting later this year. When that happens, and this is just showing you what I said, it's going to create what is effectively a pool, a shared pool of liquidity for all founders and all investors, creating a token that's asset-backed. We think that over 300 billion of assets over 10 years will come from the fund, and there'll be about 3 trillion tokens rewarded over those years. Now, to make it really interesting, we're also opening up the marketplace to any illiquid asset owned by any investor or founder ever. So if you're sitting on 3 angel investments you made 5 years ago, you can bring those investments to the marketplace and trade them for venture tokens. That will mean the marketplace will have not 300 billion, but up to $2 trillion of illiquid assets 10 years from now, making it the biggest secondary market for venture investments in the world. Now, the interesting thing about this venture fund, and I'll go quickly now because now we're running out of time, is that it will not have any limited partners. This is a crowdsourced venture fund from an ICO. And so as it makes exits, very similar to Andrew's vision, it will reinvest the proceeds of those exits in new investments. So it's evergreen and what we call in the UK permanent capital. So it benefits founders, it benefits investors, it also benefits crypto buyers because the asset value of that token, which ICOs for 1 cent, 10 years from now, simply based on the fund's investing activities, the asset-backed value will be 32 cents, which is about a 70x return, which is, very, very respectable. So we're helping everyone. There's going to be an ICO. I won't go into details because this isn't what that's about. There's a good team and so on. So that is how taking value from an ecosystem, enshrining it in a token, and that token being the primary store of value for an asset class is going to revolutionize the world. And it's at a point in history when global infrastructure is beginning to eclipse nation states and the currencies that they print. So that's my talk. I hope that is interesting and allows you to put what you've been discussing in a 60,000 foot context. I'll stop sharing my screen. I don't know if we've got any time, but I'm happy to interact with you guys there if you would like me to. And I'm not hearing sound back, so just so you know, I can't hear anything back right now.
Hello? Oh, there we go. Hey, Keith.
Oh, now I hear.
Thank you very much. I had my mic off so you couldn't hear me going running around like a chicken with my head cut off. Can you hear us?
Yes, I do. I hear you well.
All right. Well, that was very, very awesome. Can I get any questions in the room? Anybody? Yeah, here we go. One sec. We got some questions for you, if that's all right. Can you take questions?
Yeah, you'll have to repeat them for me, I suspect, unless you give him the microphone.
Hello, how are you doing?
Doing well, thank you.
Thanks for the presentation and everything. From what I'm gathering, you're going to be able to combine your existing companies that you invest in. There's no limited partnerships. And you also will, if I invested in another crypto ICO that didn't do well, I can bring that into your platform, right? Is that right?
That is right. That is exactly correct.
Okay, so doing that, I guess you're going to be having other ICOs that didn't do as well, and there's going to be still some sustainable perpetual value, even if those previous ICO that had nothing to do with yours didn't do as well. You can bring them in. Yeah,
you'll be able to put any asset into that marketplace and offer it to venture token holders as a swap, if you like. The price will be determined via an auction mechanism. So the price will end up being the price at which you sell everything, if you know what I mean, like a Dutch auction, I think that's called. So the price will be determined by the interaction between the buyer and the seller, not by us. We'll be putting every token we buy in there as well, 80% of everything we buy. So if we come and buy Andrew's token, and let's say we buy early and large, Andrew will probably give us a discount. We'll take that discounted price, and that will be the listing price that we put it into the marketplace at, not the current trading price. And then the auction will figure out how many venture tokens want to trade at that price, and it'll set a price. So there'll be tokens in the marketplace. There'll also be equities, but with equities, we're doing a different method. We're basically selling a future distribution. So you don't actually buy the equity because the legal process would be too complex. You buy a contract for future distribution. So you're buying a % of the equity's future upside. Think of it as a future contract, which we'll do as a smart contract. So either equities or tokens can go into there, and anyone can put them in.
Okay, the other part of it, so that ICO coins, tokens that I have from another previous investment. So you're going to be using the blockchain to trust it, to verify it on the ledger that was from a previous iChain. So that'll be connected to yours via the blockchain ledger on the open ledger. Are you going to create a sub ledger based on the ledger that there is, for the trust factor? Thank you very much.
Close, but we're going to create a smart contract for every transaction. So the smart contract will link the ledgers required to make the transaction happen. I hope that answers the question.
Thank you very much. Thank you very much. Keith, we really, really appreciate your time. Sorry you couldn't come out to come to the Kentucky Oaks and the Kentucky Derby with us here at Run for the Unicorn, but we really do appreciate all your support and all that you've given us so far.
Well, you know what? I'm here to support you because you're doing some awesome stuff. So it's really me thanking you.
Thank you a lot. Thank you very much.